Aaron, as valuation professionals, we both always have our eye on enterprise value, and certainly most valuation professionals that I'm speaking with these days think that ESG is value relevant. And if you think about it, it makes sense because what you're really saying is we're asking companies to focus on stakeholders such as employees, customers, and others in their value chain. Now, some would argue that that's inconsistent with the traditional model of sort of shareholder capitalism. But in my view, it's not really the case. I mean, investments in stakeholders are things that have an impact, a real impact on the future cash flows. And of course, that is a key input into determining the value of an enterprise in the kind of the traditional sense. So with all of that in mind, I see a lot of companies that are increasingly working to bring ESG type objectives not only into their strategic agenda, but probably just as important into their capital allocation process. And I guess I would argue that any company that doesn't have a strategy that incorporates ESG is unlikely to have a resilient business model in the future, and so is really at risk for having a long-term value proposition that is in question.
Yeah, maybe Andreas, let me chime in. You've hit on the concept of long-term a handful of times in that opening, and I would offer to you that the stakeholder-shareholder debate is fascinating. We could talk all day about it, of course. But I would tell you that, in my view, one of the simplest resolutions, if you will, or reconciliations between stakeholders and shareholders is really getting companies to think more about the long term. And by long term, I mean more than next year or next 3 years even. You and I both know, right, most valuations are a function of cash flow occurring well beyond year one or year two or year three. And many businesses, most values coming out of cash flow occurring beyond year 5 or year 10. And yet, if you go and look at strategic plans, we've seen hundreds, if not thousands of them over the years. Many of those are going to be 1, 2, 3-year planning cycles, maybe 5-year cycles for some companies. Some really best-in-class companies are out at 10 years. But there's this weird gap between kind of really understanding the long-term prospects of a business and how planning gets done strategically. ESG may very well be the impetus for fixing that problem, in my view. If you think about why, because the risks we're talking about here for ESG, particularly as you talk about E, are long-term tail risks. And yet the decisioning we need to do as organizations about abating those risks is happening now and increasingly happening faster. So I do think there's one point here to make, that finance professionals really need to be thinking about how are they going to plan for long-term forecasting. The other thing I'd add into that is kind of a second part of how do you deal with all the uncertainty here. Also true that companies should be thinking about more than one forecast, right? The idea of scenario planning is one that we often talk with clients about in terms of upside and downside risks. We see many organizations that look at kind of one forecast. And for some companies, that's made sense historically, right? Relatively low growth or stable growth companies may not feel the need to really understand upside, downside. ESG is changing that conversation. The reality is these risks are very uncertain. We don't know exactly where things are going to land. And so I'd offer that the flexibility companies need in making decisions that they can course correct over time really requires more of a scenario view of the future. As part of that, I think the other part of forecasting that's complex here is just the nature of some of these things are very intangible. So lots of intangible assets, intangible attributes associated with those assets. Again, that discrete forecasting, I think, helps us in that regard.
Thanks, Aaron. I'm glad you mentioned both intangibles and uncertainty, two topics we contend with all the time in the valuation space. And if you think about it, I mean, for most companies in the economy today, intangibles are the most significant investments that they undertake. And so it is an area that needs a lot of focus. And maybe one of the things that people haven't realized about intangibles is they're fairly sensitive, many of them, to how successfully a company is executing on its ESG strategy. If you think about a building, right, the value of that building doesn't really change much depending upon how the company that occupies it treats its workers or what kind of relations it has with its customers. But if you think about, say, a customer relationship intangible, which is one of the most significant ones for many companies, it's very dependent on that. So, your customer base may not be willing to do business, or may reduce the amount of business that they're willing to undertake with a company that has a poor ESG profile. And that decline, again, in the future cash flow prospects would have a very real impact on the value of that intangible. So, maybe one of the things that I would suggest people think about is that, we have this like sea of ESG data and information and ratings and things, and it's quite a challenge for people to make sense of all of that. That one of the best yardsticks, in my estimation, of how you can assess whether a company is doing well on ESG is to look at the change in the value of their intangibles over time, because it's really, in my mind, a very good barometer of how well it's being managed. Your customer relationships, your workforce assets, and your brands being classic examples that are very sensitive to this, to ESG strategy success. So, Aaron, anything else you want to add to that?
Yeah, you mentioned one thing, and it's a really maybe a good way to close here, Andreas. You talked a little bit about changing consumer behavior, customer behavior as a function of ESG profiles of a company. I've had, dozens of conversations in the last month, 2, 3, with companies about ESG, broad, wide-ranging conversations. Invariably, those conversations often come back to questions from management about what are the risks of ESG to my business? And that's a perfectly logical question, and certainly something we hope management teams are asking. What might be the consequence to me of climate change? What is the risk to me of having a less than diverse workforce, et cetera? Here's the challenge from my perspective. I don't believe that stakeholders are principally or primarily asking companies to think about ESG as it relates first and foremost to the risk to the business. I think stakeholders are actually asking companies to think about the risks of their business on the world. What impact does your company have, good or bad, on the world? And in traditional sort of classical economics, things that companies do that may be bad for the world, like pollute within the limits of the law, historically are looked at as externalities. I don't have to pay for it. Society does, unfortunately, but I'm allowed to do it. Increasingly, what we're hearing and seeing from a behaviors perspective is that companies are now on their back foot with respect to those externalities. Those costs are starting to be internalized. How? Because consumers are making different buying choices and employees are making different employment choices. Those externalities as real costs need to be in view, from my perspective, I think you'd agree with this, Andreas, for our finance teams, because it really is starting to weigh on cash flow directly.